Oh, I know I'm going to ruffle some feathers with this one. In this video here, we're going to be doing a stock analysis on Tesla. I want to look at the fundamentals, the financials, and finally determine a price to pay for Tesla to see, what's this company really worth? If you're new here, my name is Leo, and my channel is dedicated towards all things investing. Without further ado, let's jump into Tesla to determine what this company is all about. We pull up Tesla here in the stock research tool built by yours truly. We're going to go through 3 different categories here. We're going to look at our company metrics first, and we'll pull that up right now. And this category here allows me to take a look at the company where it's been standing over the last 5 years and try to compare it to the trailing 12 months to try to gauge where it's going. Right off the bat, we have a really high PE ratio. We're sitting slightly below, well, a lot below that. We're at 179, but still incredibly high. Improvements on EPS, much improvements on ROE, 5.5 billion in net income, 3.43 in free cash flow. Our average free cash flow is at 557 million. Yeah, we got some negative numbers here. Oh my god, we've only just started going positive in 2019? Oh my god. We're up on our return on invested capital. We're sitting at an Allman Z-score of 19, which is great. We want that over 3, which is phenomenal. And we are at a Peter Trotsky score of 7, also good. We want this between 8 or 9, but 7 is also a decent number. So right away from our 5-year numbers here, we've definitely seen a lot of improvements from Tesla. So it looks like they're heading in the right direction. Like there's some numbers here that are in the negatives, like our profit margin. We were just in the negatives, and now we're finally in the positive for our trailing 12 months category. Return on equity, it was in the negatives. Low EPS, and this high PE ratio, well, that's going to bite us in the ass a little bit later on, but we'll discuss that in a second. And a very low return on invested capital. Crushing these negative numbers is going to be crucial to getting a proper evaluation. So that's my thoughts on the company metrics. Let's go over to the financial evaluations category to see where this stacks up. And we are ranking this 4 out of 10, and the points where it's going to earn points is in the EPS growth, which is a high number here as we discussed. Debt to equity, it being at 22.91, meaning that they're generating equity within the business. We want that under 50%. Our net income is growing and our revenue is growing. We were showing a decreasing free cash flow of a negative 184%, when in reality it should have been positive 184%. So we're showing that right now. So technically the score is 5 out of 10. So we're seeing net income growth, free cash flow growth, and 5-year revenue growth. Those are 3 categories right off the top, which I really enjoy: the net income growth, the free cash flow growth, and the revenue growth. Debt to equity, that's also decent too, along with EPS. However, that's only 5 out of 10. And we're losing points in a lot of key areas. Share dilution is 1. It's not the worst at 2.60%. However, we want this number just staying the same or decreasing. And over the last 5 years, they've been diluting you. And I know in some evaluations, if you've watched my other evaluations, I'm somewhat forgiving on that number. However, it's hard to be forgiving on a number like that if the PE average looks like this. Guys, it's 630. So that's the massive number. We want this number to be under 22.5, and my god, it is astronomically high. Current ratio, we're staying at, it's at 1.38. We want this to be over 1.5. just to indicate that there's enough assets on hand to cover our liabilities. And while we do have enough assets on hand to cover our liabilities, it's not quite at that mark where I want it to be, because that 0.5 difference is great in case, just as a buffer, and we want to include enough margin of safety wherever we can. Now, return on equity, we're sitting at negative 11.55. Now, this is the average. Granted, it is sitting at a 21% trailing 12 months, but on average, we haven't been that profitable and only been a profitable business come 2019. 3 years now of them being a profitable business. Something to keep in mind, folks. Something to keep in mind. That's a 5-year average. We're sitting in the negative. And then obviously our return on invested capital is sitting at 2.38%. We want that over 10% or 10% or higher. That just indicates to me that, they're making a decent return on their money invested. We have that in the trailing 12 months as we express in our company metrics. However, it's not looking too good over the 5-year average. So these are things that definitely concern me, and I'm not too impressed with this score. What I was saying earlier in the company metrics, just to echo that, I believe that they're heading in the right direction. Not saying that they weren't doing that prior, but heading in the right direction where they're going to probably grab the attention of a lot more value minded investors. When you have these astronomical PE ratios and negative return on equity, just being a profitable business at the last few years, you're not going to get looked at by a lot of these big time investors. Unless you're really Kathy Wood, because Kathy Wood absolutely loves this company. If you're liking the video so far, folks, make sure you hit that like button and the subscribe button. They can both be found right over here. That looks good, right? Right here, below this, my finger here. Makes me feel warm and fuzzy inside. And this software here, if you would like it, send me an email. That's in the description down below. So let's jump into a price analysis, folks, and let's determine what a fair price to pay for Tesla would be. We have 3 categories here: conservative, moderate, and aggressive. We're going to be conservative on everything, slightly less as we go along. And this is going to be very interesting, folks, because we definitely have some negative numbers, and you know how I feel about negative numbers, where I'm going to have to speculate a little bit. We're going to put a 10-year evaluation, and we're definitely not going to use these high numbers at all. I feel like if I just do 20, 25, and then 30 on the high side, profit margin. So I'm going to go with, let's say, if I had to reference another company like Ford or some other thing, I'm going to go 5, 8, and then I'll go 10. Free cash flow margin, I'm going to go 4, 5, and 6. A lot of people are going to probably criticize me for being like too conservative. I don't really care, because here's the thing. You got to assume the absolute worst with these businesses, because you want to at least have some sort of margin of safety kind of going into it, and also try to be somewhat realistic. Price of free cash flow, my God, it is at $284 or 284.81. It's gonna be rough. I'll do 16, 18, and 20. About 20, 22.5. Maybe I'll even do 18, just because I'll try to go as high as I possibly can go, because these numbers are astronomical, folks. All right, desired return 13%. We hit one number, guys. We hit one number in our earnings multiple calculation here. But look, guys, this is where we're sitting at. We're sitting at $400 a share. And granted, I even think that's too high. I think that's way too high, assuming these high revenue growth numbers. It's $1 trillion company. $1 trillion company. It's sitting at $53 billion in revenue. Like, I would have to go even like 10, 15, like 20. Like, that would be realistic. And look, this is where a lot of people are gonna get mad at me. It's like, they're gonna say, how can you even think it's priced around this? Tesla's going to the moon, and totally just try to justify this $1,000 price tag. No, guys, it's low. It's at 191.67. I think it's even between here, to be honest. Definitely sub 160. I would even be happy if it got to 160. Like, you're gonna tell me and just try to justify this price of free cash flow and this PE ratio of over $179 or 179? Like, the insanity. Here's the thing with this company. There's such a huge cult-like following behind it that it just keeps like ramming the prices right up. And a lot of people, I think, are going to get hurt when they realize that the valuation of this company just doesn't make any sense. I think the cars are great. I like Elon Musk, but my God, is this stock does not make sense. And everyone I try to talk to just thinks I'm an idiot, because they're like, oh, how can you not invest into Tesla stock? I'm like, well, I just don't want to overpay for it. If it's the proper evaluation, then absolutely sure. Proof is in the pudding here, folks. Free cash flow numbers is the ones I'm most concerned about. Because look, we just started generating free cash flow 2019 on a positive side. You see that? Like, we were negative since it IPO'd up until 2018, that fiscal year. After going forward, we finally decided to turn around, wake up, and actually get some positive free cash flow. And even look, net income. Positive only in 2020 and 2021. And negative just across the board. Negative net income. How are you going to justify How are you going to justify a price like this? Price like that for a company that just started making money in the last couple of years? Like, this is what I mean. Like, it could definitely grow around this much per year. But keep in mind, folks, there's Ford, GM, Volkswagen, you have even Rivian, Lucid, NIO, all these other electric car companies coming out of the woodworks. And it has me concerned for this business because of how grossly overpriced it is. So, I don't know. I'm avoiding this for now. I think a lot of people are going to probably get hurt if they bought up here. Like, look, it climbed to a high of $1,200, folks. Just be careful with this one because the moat is shrinking. That's my opinion. Not to say the moat's shrinking, but the market share for the electric vehicles is definitely going to be eaten up by a lot of big fish. And now you got to hope that Tesla is the shark in the water. We'll find out. But I'm avoiding this one for now. Always do your own due diligence. But if this company goes below 160, you know what? I might pick it up. I like Elon Musk. I like where this company is going. I just don't like the price. And that's the important thing, folks, where you got to always just keep in mind is you can love the business, you can love the company, you can love the product, but if the price doesn't make sense, why are you going to buy it? Anyways, that's the video. Smash the like button, hit the subscribe button, show me some love. Thank you. I'll see you in the next one.